hello everyone, and thank you for being here. My name is Emily Fritzendris, and I am an executive MBA student, class of 22. And on behalf of the Student Leadership and Ethics Board of the Bernstein Center of Leadership and Ethics, I'm honored to welcome you to Columbia Business School's panel entitled The Ethics of ESG Investing and Branding. This is going to be a 45-minute event, and it's part of Leadership and Ethics Week, which is hosted by the Student Leadership and Ethics Board. We, the board, is a student voice on ethical leadership activities at CBS, and our purpose is to foster a culture and safeguard a tradition of principled leadership at CBS, and we do this through events like this. Leadership and Ethics Week is one of our signature programs, and we hope that it helps CBS students to become more productive, moral, and caring future business leaders. So please check out the many other events that are happening this week on Zoom and in person. It's really a wonderful opportunity to unpack these issues. And so now I'm delighted to introduce my fellow board member, Sam Sonenshine. Sam will lead a conversation on ESG investing and branding, which is a topic of increasing relevance in all of our business sectors. And I hope you tuned into some of the materials shared in advance. And we have special guests, CBS Professor Mark Zurack and Alex Friedman, who is a CBS alum. I had the joy of taking Professor Zurack's capital markets class during my tenure here. And despite my non-financial background, it really inspired a personal passion for me on this topic. So I offer particular thanks for being here. And I'll hand it off to you, Sam, to lead the conversation. Thank you all.
Thank you so much, Emily. And thank you to Alex and Professor Zurack for being with us today. So just to quickly set the table, Professor Zurack is, as Emily mentioned, senior lecturer in business here at CBS. He teaches the capital markets course as well as an equity derivatives course and an ESG investing course here at Columbia Business School. Prior to coming to Columbia, Professor Zurack worked at Goldman Sachs for 18 years. He joined in 1983 and started the Equity Derivatives Research Group, and he later assumed a broader leadership role in equity derivatives, co-managing the product in both North America and Asia. He also, for some time, served on the board of directors at the Chicago Board Options Exchange. So Professor Zurack brings perspective to this issue as obviously an academic perspective, as well as a portfolio manager and investor's perspective. Alex Friedman is with us. He got his JD MBA here at Columbia in 1998. He's the CEO of Novata, a mission-driven technology-powered public benefit corporation designed to improve the process of ESG diligence in the private markets. He also founded Jackson Hole Economics, a nonprofit research organization that provides analysis of key topics in economics, politics, the environment, and finance. And he also has served in a number of executive roles, including CEO of GAM Investments, a $100 billion asset management firm, as well as global CIO of UBS Wealth Management. So he brings the perspective both of an investor in the public markets as well as an advisor to companies in the private markets. So to start with, I just want to talk a little bit more about, have you guys talk about your backgrounds and what has, how you've developed your particular areas of interest. So Professor Zurack, in particular, I'd love to hear you talk a little bit about how your work in the derivatives markets has developed your interest in the topic of corporate responsibility. In particular, I'd be curious to know how your views on systemic risk have evolved over time, especially over the last 15 years, as that's been an area of focus within the broader world of ESG investing.
Okay, quite a mouthful. Let me take a crack at it. Thanks, Sam. So it's interesting. I started in derivatives in 1983, and the analogy I bring to ESG, having just really started studying ESG in preparation of the course for a little under 2 years, is that to me, it's in the, like derivatives when I started, it's in very much the early innings of development. And in public markets, and Alex, based on my understanding of your background, probably focus more on private markets, but in public markets, which is where my course landed, I think investors are trying to figure out how to use the tools that they've got available to them and understand some of the weaknesses in the tools that they have available to them in ESG investing. And in that regard, I think 10 years from now, people will look back and say that we were kind of somewhat Neanderthal in terms of how we were using the products relative to where we're going to head. And in that regard, I think it's very, very similar to derivatives, where it just really took time for people to get a better understanding of how the vehicles could be used. In terms of your question about systemic risk, I think systemic risk is part of the evaluation of sustainability. I think it's hard to evaluate in advance because you're always kind of fighting the last war. But I think that post 2008, some of the regulatory changes have been pretty helpful in terms of capitalizing financial institutions, in terms of providing more transparency to different trading venues. So at least for now, I haven't really seen anything that I would think of as problematic. And in fact, if you look at what happened during the pandemic, the markets functioned pretty well despite all the volatility. I think if you look at some of the newer investment fields, whether it's cryptocurrency or some of the stock trading that's momentum based, I think there's potentially some systemic risk coming out of both of those strategies because the strategies are so new, and I think there could be a shakeout there. Do I think it affects sustainability? No, I think the people who risk their capital getting involved may find themselves getting burned, but that's capitalism for you. So I'm not so sure I would be that worried about its impact on sustainability.
Alex, you've always had kind of one foot in the business world and one foot in the public and nonprofit sectors. I'm curious how your career experiences have informed your views on the interaction between business and society, which is, I think, really what ESG is speaking to.
Yeah, thanks for having me here, Sam. It's great to be back with the Columbia crowd. I did spend a little time in the White House in the Clinton administration, and then I was the CFO of the Gates Foundation, which is in the nonprofit world. So those two kind of dimensions, I guess, with 25 or so years in the business world, has given me a little bit of perspective on the interconnectedness of things. And I guess ESG, if you kind of take a step back, it's about the competing tensions between what my generation grew up with being told is how business should function, which is kind of the Milton Friedman school of, shareholder supremacy. The job of a company is to maximize profits for its owners on the one hand. And now what I think all of us are grappling with, which is that leads to a kind of a series of tragedy of the commons outcomes, the climate crisis being maybe the most pronounced one right now. And that we can't view kind of the challenges we face in isolation. We can't just say I'm in one vertical and the rest don't apply. To me, the kind of lesson I've taken from the experiences I've had is that all the different dimensions of life need to work together, whether it's in business or government or a nonprofit foundation world. So ESG for me is about all the elements that a company stands for, which is its employees, what it does, its owners, the physical environment it operates in, the reputation it has, and how it either contributes to a positive tilt towards justice in the world or detracts from it? Maybe that's a long-winded answer, hopefully, to your question.
Yeah, I think stakeholder. You mentioned stakeholder capitalism, and this is this is kind of an ongoing public part of our public discourse is this interplay between the shareholders on the one hand, and then the much broader universe of stakeholders on the other. In recent years, have you both seen examples of companies or industries that have successfully worked to align those sets of interests?
You want to go first, Mark?
Sure, go ahead.
Oh no, you go. You go.
Oh, okay, sure. Well, I think what I do think is there's a recognition, and again, I'm looking at it from the public markets, which is, I think, somewhat different because just the amount of control you have over your process is a little less prominent, and you've got more legacy issues because the companies have been around much longer. But I do think that the industry has really gotten enough press and enough credibility that companies worry about the way they're viewed on an ESG basis. And to me, that's not an insignificant progress. I think it's significant. I think the difficulty is that when you use the term ESG, you're working your way into something very broad. And if a company focuses on one aspect of ESG, say E, it may not result in them being viewed very differently on the broad ESG basis, because there's so many factors in how a company is rated, so that I think it's actually hard to move the needle. I think if anything, the whole trend has affected probably the companies with the low ESG ratings more than the ones with the high ESG ratings, because it's given them some impetus to improve their lot, from what I can see.
Yeah, so let's get into the specifics of how ESG is measured, and I think as a starting point, we could talk about the number of our like the pre-submitted questions where people want to hear about your guys' views on the new proposed SEC disclosure rule. Alex, you recently wrote a piece about this for Barron's. Could you just describe the proposal at a high level, and in particular, you especially your work focuses on the private markets. The SEC disclosure rule is focused on the public markets, but there is an interesting private market component to it. Could you explain that?
Sure. Yeah. So the SEC recently came out with a proposal, which it's in comment period, and it's very possible it doesn't go anywhere depending on the politics, especially in the midterms. But it may not matter because the market's already moved, I believe, towards putting enough pressure on public company executives and boards that a lot of what the SEC is getting at is going to happen anyway. What the SEC basically said is, if you're a public company, you should start reporting on more than just financial results. And you need to report on your scope 1 and scope 2 emissions, and maybe your scope 3 emissions. Scope 1 being direct, scope 2 being indirect, and scope 3 being the doozy, which is not only your own emissions, but the emissions of your suppliers as they relate to the work they do for you as a company. And that's very hard to calculate. Now, before I get into the private point, it sounds like a big deal what the SEC's proposed, but just to put it in context, the UK government is already in law now, has a law called TCFD, which is the task force, came from the Task Force on Climate Disclosure. And it's going to do a lot of the same stuff in the UK. So the world is moving this direction. And in Europe, the European Union, SFDR, which is also an acronym you might have heard, is also taking place. We'll do a lot of the same stuff. Now, the implication of what I wrote about in Barron's is, I think, kind of interesting, which is that even though the SEC said you don't actually have to report on scope 3 emissions, public company, unless you've gone out and given a target externally. In fact, most public companies have already given a target because they've signed up to these net zero commitments. And as a result, they're going to have to report on their scope 3 emissions. And if you look at the supply chains of public companies, they're predominantly private companies, like 90+% of the suppliers. And that means that for a public company to comply with what the SEC is asking, it's now going to force its private company suppliers to give the same kind of climate disclosure that they're going to have to do, which means private companies around the world are going to start having to track their emissions. That's really significant because there are about 50,000 public companies in the world and there are about 200 million private companies. So even if you think maybe 5% of those private companies actually matter, you're talking about like 10 million private companies having to get sophisticated about tracking carbon emissions. And that's a great thing because climate problems are a tragedy of the commons and you can't just limit it to public companies, right? Carbon molecules don't limit themselves to legal structures. So that's basically what I wrote about.
And you mentioned the differences between this proposal and some of the proposals on the table in Europe. Where do you think this proposal doesn't go far enough? Where, like, what for example, what exactly is the UK doing that we're not doing?
It's a really interesting question. It's hard to answer that because European law actually isn't settled on this yet. So SFDR keeps getting postponed. It should take place. It should be implemented this summer. The UK is just rolling it out right now, so I can't really opine on that with any accuracy. When you say does it go far enough, the short of it is the SEC doesn't really have jurisdiction over private companies, and they don't really have jurisdiction outside of financial matters. If you go back to their founding in the 30s, so there's plenty of precedent for legal cases saying the SEC has reached too far. And we've already seen the roadmap for that in the kind of dissension from one of the SEC commissioners in protest of this proposal. But if you just boil it down to the most basic stuff, our species is facing an existential threat, and that means everybody has to do something about it. So the idea that we're going to say, well, the SEC has overstepped its mandate, to me, that's an example of it's not going far enough. What we should be seeing is a rallying around this kind of a change in direction for the SEC. Just like we see a rallying sometimes around the Fed when it changes its direction. The Fed's got a dual mandate. The Fed has kind of thrown out its dual mandate right now, which is because they're trying to get inflation under control. So I think we have to recognize that public policy is a very blunt instrument and that it needs latitude in order to accomplish public goals. And there's no more important public goal than addressing the climate crisis.
So the SEC proposal covers E, the environmental impact of companies, which arguably is the easiest of E, of E, S, and G. E is probably the easiest to measure because not that it's easy, but you literally can measure the amount of carbon that any particular action is associated with. Alex, in your work, how do companies, how do you create frameworks for companies to quantify their impact on society, on their workforce, on equity and inclusion, diversity, as well as on corporate governance?
That's a big question, which Mark will have a lot of views on. I'll try to start with it, but maybe you can save me when I fail, Mark. So first, you use the word impact, and most people, I think, don't understand the difference between ESG and impact. ESG is a bunch of different metrics that a company might track, and often the company will mistake the movement on the changes on those metrics for impact. They'll say, well, I got more diverse on my board, so I must be moving in the right direction. Impact is inherently subjective, and it's about what do you as a company view your mission? Is it to educate more students? You're a test prep company. Is it to produce better products? And you have to then create custom metrics around those, around the kind of mission of what you're trying to do. And then that becomes the core of impact measurement. You can't quantify a lot of this stuff against some objective standard. The best thing you can do is benchmark. So that's what we set up a company called Novata, and it's designed to basically be like an on-ramp for companies to figure out what metrics should they track and how do they figure out what they mean. We're not doing rankings. I think this thing all got haywire because of rankings. So public companies started competing. They were trying to measure everything, and there were all these outside groups that started ranking them, and the rankings are all over the place, and the data is really poor. The best thing to do is actually just benchmark. So you get everyone to participate in the idea of tracking relevant metrics, and then you anonymize them, and then you make it available publicly so an individual company can see how they stack up relative to their peers. Then they can make their own subjective assessments about trade-offs and prioritization and using limited resources to improve in areas that they think matter the most. What do you think, Mark?
I was just going to add the following. First of all, carbon emissions is only part of E. So therefore, to say that to try and link ESG with regulations on scope 1, scope 2, scope 3 emissions is like trying to say that 10% of something is the same thing as the whole thing. It's really only a small part. So that's part of the tricky part of the point Alex made earlier, which I've heard, and he's an expert in the industry and I'm just more an observer, but I've heard this from other experts, that they don't necessarily believe the rating agencies for ESG, because if you look at any given company and any given rating agency, they're not going to rate them the same. In fact, the correlation across rating agencies is about 0.4 versus 0.9 for bond rating agencies. So I think there are a whole bunch of issues. One is a recognition of the difficulties, and it's not because the rating agencies are not working hard or they're not smart. It's because it's hard. It's a hard thing to quantify.
Well, and the data is all over the place, Mark. The data is mostly subjective, outside in, like data scraping, using algorithms. That's part of the problem.
Right. So as a result, you're almost trying to put things in a box with a nice little ribbon wrapped around it when it's all over the house. Mm-hmm. That's why I keep coming back. It's so much of the early innings, and part of it has to get to disclosure, but in terms of having more consistent disclosure across companies. From the investor's perspective, though, it makes it a challenge because you have to kind of define what your objective is. And not only have you to define what your objective is in using ESG, you also have to define how you're going to keep track of it. And what reporting you're going to provide on an ongoing basis to make sure that you're fulfilling your mission. Mm-hmm. And that's not easy. And that's one of the things that the SEC, I believe, is worried about, is the ongoing reporting, the auditing of companies. Definitely. And within their audit, are they doing what they say they're doing on ESG?
Greenwashing. Yeah.
Mm-hmm. Yeah.
Yeah. Well, let's get into that topic. So there's been a number of critiques recently on how Wall Street is approaching the topic of ESG investing. There was a recent Harvard study that suggested that ESG investing often results in little improvement of the company's actual performance, and can actually end up directing capital into poor business performers. Matt Levine's written extensively about this for Bloomberg. Tariq Fancy, the former CIO of sustainable investing for BlackRock, has been a vocal critic of ESG branding of ETFs, of different investment products, as kind of ESG friendly. And these critiques seem to be in line with what you two are saying in terms of needing ESG metrics to measure performance as opposed to rank performance. That a lot of these critiques seem to be arguing that where we start to get into trouble is when a fund or a company labels itself as being ESG friendly. I guess with that as backdrop, how would you guys define? And I'll put the question to you, Alex, since you used the term. How would you define greenwashing, and how do we combat it?
You combat it with disclosure. Is the best way. You shed light on things. People can then make their own decisions. I think of ESG today as like where the US was before GAAP was introduced, GAAP accounting. So companies reported what they wanted. Reporting was all over the place. There was a lot of fraud. You could have called it greenwashing back then with a different term, but it was the same thing. They were trying to, maybe look one way versus what they actually were. And so the SEC was created after the Depression, and part of the mission was to avoid manipulation of financials. And so the SEC turned to the accounting industry to create generally accepted accounting principles. Right now, ESG is all over the place. It's just like it was before GAAP came about. At some point, there will be a kind of convergence around some baseline standards and metrics. I should say metrics, and then companies will report against those metrics. There'll be whole industries that develop to do verification, just like the accounting industry and the consulting industry, adapted to GAAP. And then there'll be analysts that analyze from the outside in that information, and you'll have a more informed view of kind of the ESG landscape than what we have today. Like Mark said, we're just at the very beginning of that. In my experience, I ran a public asset manager for a while, and in my experience, the challenge of investing public assets, assets in the public markets with ESG as a real framework, there are three challenges to it. First, there's no agreed upon framework for what should be reported, so companies report different things. Two, most of the time, companies don't disclose what they're reporting. They track it internally for their board and their management. And so groups that are trying to analyze those companies, they're doing outside-in data scraping. They don't actually have the real data. And as a result, when they produce rankings, the third problem, the rankings, like Mark said, have low correlations to each other. They're all over the place. The 0.4 point is really interesting, Mark, because we used to do something where for any particular company, say one of our equity managers was investing in, we'd do a nice four quadrant chart, and we'd take the top 4 rating agencies and we put a dot in each of the areas where they show up, and they would almost always be in different quadrants, sometimes all 4 quadrants. So the result was you couldn't really use those rankings to effectively invest.
Yeah, I just want to add something else that even if the metrics got better, the idea of the multifaceted nature of ESG in terms of all the different issues you're measuring a company on potentially dilutes the issues you're worried that are important to you. Like, for example, if you built, and I showed this, I think, in my first class, if you built a portfolio designed to have a high ESG rating, the portfolio's carbon emissions will be kind of average. They won't be lower than average. If you build a portfolio designed to have low carbon emissions, its ESG rating will be average.
This is such a good point. Such a good point. And it's why I was arguing the kind of the gap trajectory, because we think about investment firms. You've got every style there is, every different technique, and then that gets carved into different kinds of funds, and they get sold to different audiences depending on what you're looking for, right? People aren't buying, hey, I want the fund that gets the average across everything. They're saying, I'm a growth investor, or I'm a value investor, I'm focused on this geography, I want early stage, I want a product in this particular industry that's the best. That's where ESG is going to go eventually. It's just right now, like Mark said, it's this one lump term. And so people are like, oh, give me a good ESG fund. It's like saying, give me a good company.
Right. Yeah, you're almost better off being more specific on your mission, whether you're a company or whether you're an investor, and try and think about the metrics that surround your mission rather than just call it ESG. So it almost, I mean, the way I would look at it is ESG has been a big positive in that it's got people focused on the problem, but it's being defined in a way that just needs more development, in my opinion.
Yeah, it's in that framework. In that framework, it's Alex, I really like the analogy of looking for good ESG rating being like just looking for a good company. Professor Zurack, it sounds like this an analogy might be, you're looking for, asset light, but an analogy to GAAP financial reporting would be you're looking for asset light businesses, or you're looking for high margin businesses, or like there are specific parts of a P&L or parts of a balance sheet that that a financially minded investor cares about. Likewise, there should be specific aspects of ESG that an impact minded investor should care about.
And Sam, just to build on that, that's what we're seeing a lot at Novata. And let me try to give you some specifics. So what we do is we help private companies try to figure out, what should they report, and where do they store the data, and how do they figure out what it means. In order to do that, we worked with like 24 private equity firms and big pension funds to figure out, what kind of tools should we build. And in that process, we learned something spot on to what you both just said, which is if you go to Scandinavia, what they care about in the E, the S, and the G is more in the E. If you go to Florida and talk to the state pension fund, they don't really want to focus on the E, because the politics of Florida as a state institution are not focused on climate change. So depending on where you sit in the world, what people care about in terms of, say, responsible investing is very different. So the idea of trying to come up with one first framework or one lens from the framework to decide if something's good or bad is it's very amateur. It's like at the beginning of something before you get into the details and understand it.
So some of the questions that we received were about investor strategy through the lens of ESG. So Professor Zurack, I know you mentioned you're on the investment committee at your alma mater, as an LP, who is essentially, the LPs are kind of the ultimate shareholders that are typically LPs are solving for just a specific IRR or something, that kind of can be boiled down to something very simple. Within the ESG framework, where does can you walk us through where an ESG mandate comes from, at least in this one particular example, where the ESG mandate comes from, and how that mandate ultimately trickles down into the different allocations of assets within a portfolio?
Okay, if I guess I'll take a crack at it, Sam, but what I'd prefer to do is give a different example and leave
Sure.
the private markets to Alex rather than me. It's much better suited to answer it than I am. So I'll give you a public market example, very specific. I'm on the board of a mutual fund company, and we were asked to approve what's called a carbon aware fund, the first ESG fund offered by the mutual fund company. And the way, one of the things we did spend a lot of time on, and this is a very quantitatively based mutual fund, it is measuring expected return and is measuring Sharpe ratio. And we asked the portfolio manager, what's the difference going to be as a result of having the carbon aware requirement? And this is in the context of a fund that goes long and short. And they were pretty specific, and they actually have a fund which doesn't have the ESG component to it, which has the same strategy. So you could actually watch the two of them and you could see how they compare. Where I get, and I've been around maybe too long, so there's a certain bit of cynicism I have, but the industry, for the most part in public markets, kind of believes that you can get your cake and eat it too. That is, you can invest in ESG, have some sort of ESG benefit and actually outperform the benchmark, which if that's true, you should invest that way anyway. You shouldn't need to be given, shouldn't need the ESG imprimatur. If you're going to outperform the market, whatever strategy you follow, you should use. So I don't think the industry has honed in on how they think about the potential give up in performance or change in risk to accomplish a certain goal, whether it's an environmental goal or whether it's a broad ESG goal. I think we're very early stages. I think there's a lot of marketing that's driving some of this and maybe potentially some greenwashing.
Yeah, it's a good point in building on it. If you think about a portfolio, when you build a portfolio, you pick different funds, different managers, different strategies, geographies, et cetera, so that the whole, is hopefully going to serve your purpose from a risk-adjusted basis, right? You would do the same with, ESG writ large, meaning you'd unpack it and you might say, okay, governance is a really intuitive one, because if a company's well governed, it's probably going to do well over the long term. I want some companies that are well governed, and I can analyze that quantitatively. I can figure out, where has there been shareholder challenges, where has there not been, that kind of stuff. I think we're still in the lumping phase, and that's making these kinds of discussions, challenging when you start introducing investing, because you do have to dissect on every dimension, just like you do for non-ESG investing.
So we have a few more minutes, and I want to get to a few more of the submitted questions. A few of them are about leverage. They're about investors, how investors can exert leverage over management to achieve certain ESG outcomes. Alex, I'll put the question to you. To what extent can and should board members of companies do things like tie ESG metrics to executive compensation, or what other levers do board members have at their disposal to achieve certain ESG outcomes?
Well, the number of shareholder resolutions doubled, I think, over this last proxy season in terms of shareholder resolutions related to the E, so climate-driven ones. It's clear there's like a secular move amongst in shareholders, and that's not going to go away. And boards of directors of public companies, have a fiduciary obligation to the shareholders, so they respond to shareholder pressure, which is why proxy advisors have a lot of power. At the end of the day, my experience, I'm on one public company board, is that your job is to not try to manage the company. Obviously, your job is to be a fiduciary link to the shareholders. Where I think that gets complicated is this move we're talking about from shareholder primacy to stakeholder primacy, from the Milton Friedman school to one that we started with. And I don't think that's very clear. So I can't answer it with any real insight, except to say that the first thing we've started to see is what you already pointed out, Sam, which is tying executive compensation to, certainly E metrics, and then some diversity in metrics, not so much pay gap in this country. I think that's more true in Europe. But even the E metrics are pretty simple. They're very early. They're kind of, scope 1 type stuff.
Professor, from your experience on boards, have you seen movements to enact outcomes that are not purely profit driven, that are impact driven?
well, they're certainly impact driven. Whether they are or not profit driven, you could debate. But I think what I cover in my class, which I think is a classic example, is this movement by a very small firm called Engine Number One, who basically is a small. They have multiple funds, but you could think of them. One of them is a hedge fund. It's a small hedge fund, but it's activist, but activist towards sustainability, sustainable activism. And what you also have going on in the world is, as I'm sure you're aware, is that a reasonably large percentage of all assets are managed passively. And the passive managers, I believe, certainly on the environment, and it's not just Larry Fink, but he's the most public out there, are supportive of environmental measures, but don't want to be activists. So what Engine Number One is, they basically took on the role of the activist, but they had all the votes from the different passive managers to support their activity. And as a result, they received 3 board seats on Exxon's board, which caused them to kind of rethink their corporate strategy on energy. So that was kind of a classic example of change. But the genesis of the change was not what you were expected. It wasn't a large firm, a large investor. It was a small investor that harnessed all the large investors together.
Do you see activist investor activity increase? I feel like it's gotten a lot of news coverage over the last couple of years, but that might not be an indicator. Do you see activism, investor activism, increasingly being used as a tool to impact ESG related outcomes?
Yeah, I mean, investor activism 101 is about going after compensation of executives. That's that's one of the classic, ESG metrics that people like to focus on, which is pay gap. So its history is in ESG in a way, even if it doesn't seem like it. And yeah, just the sheer number of shareholder resolutions and proposals in the proxy season on climate would indicate it is likely.
Mm-hmm. Well, we're coming up on time here. I really appreciate both of you for your time and your thoughtfulness around some of these questions. It's a huge, not just a huge topic, but a huge set of topics to try to tackle in 45 minutes. But I feel like we've gotten a little bit of clarity around how to approach these questions. If anybody is interested in doing a deeper dive, Alex Friedman's recent writing in Barron's is a great resource, as is Professor Zurack's class on ESG investing. And thank you to the Bernstein Center for putting this on, and enjoy the rest of Leadership and Ethics Week.